Hello everyone, my name is Kamal Manocha. I represent PMS AIF World. Welcome again to another insightful webinar that we have organized today. Today's guest, Mr. Harsh Agarwal, is head of alternates at Tata Alternative, Investment Funds. He comes with more than 2 decades of experience. I have particularly known him of late over last couple of years, especially with regards to Tata's two long short funds. And I regard his experience and his knowledge with regards to this space, and that is what has motivated us to do this webinar with him to primarily learn and impart knowledge for our audience with regards to this upcoming space. We have recently seen, the fixed income space has more or less changed forever because of the announcements done by tax authorities with regards to the indexation benefit taken away for debt mutual funds for HNIs and ultra HNIs who can afford to take longer term calls on their debt allocations and can kind of invest in relatively less liquid products. This has actually opened doors for various alternative investment funds, and especially in category 3 for long short funds, and that is where we also want to learn in depth that this particular space, because Tata's funds objectively have been evaluated as good funds. In fact, I would say best funds in this category over last 3 years on risk adjusted returns. That is where we kind of have asked Harsh to take out 1 hour's time today to cover this entire space for our audience. Also, many HNI clients and I myself, being an investor, if I put myself in investor's shoe, I realize that macro environment, as always, even today, is uncertain. Though valuations on equity do not look too stretched, in fact, they are kind of decent. But yes, levels are again back to 18,000. Markets in US are still again showing, kind of volatility after having seen a decent run up over last 6 months. So obviously, this kind of makes investors on one side, I would say, seeing the equity markets with a lot of hope and to an extent greed to make money, say next couple of years, because last 2 years have been full of disappointments. At the same time, because of the uncertainties, investors feel fearful. So to manage this entire emotion, also long short funds actually come up as smart products. So why do we call them as smart products? What do long short funds offer? How to select long short funds? What is this entire space of long short funds? We will cover all that in detail academically. We are not here to sell any product, but to impart knowledge and understand and learn from this fund manager. Welcome, Harsh, to this webinar. I have set the context for you, so over to you, to begin with, and then once you have covered your first part of this webinar in terms of discussing and giving answers to some of these questions and expectations that I have set up in this context, we will do Q&A. I will urge everyone in the audience to ask, as much questions that you want to ask. We'll cover them all after the first part is over.
Thank you, Kamal, for having me here, and good evening, everyone. So let me just set the context here, about the tax changes that have come in, and which has forced the investors to look at alternative options. So, firstly, as you all know, the debt mutual fund taxation, the LTCG benefits has been taken away. So whatever gains you make on debt mutual funds, it will attract marginal tax rate depending on individual's own tax slab. Similarly, one particular debt instrument which was very popular, which was market linked debenture. So many investors, ultra HNIs, were claiming LTCG benefits on those as well. And Finance Ministry, through its bill, has made it abundantly clear now that MLDs will not qualify for LTCG, which means that even MLD returns, or these will be attracting full applicable tax rate. Likewise, there were loopholes on the insurance products which have been now plugged. And similarly, there were slight loopholes even on REITs and InvITs. To the extent that REITs and InvITs were repaying capital to the investors, those were considered tax free. And now, Finance Ministry has made it clear that large part of the REIT InvIT incomes will be taxable. So which means while earlier these instruments, including debt mutual funds and MLDs, they were looking like 7% kind of post-tax product. Now their profile has deteriorated for an investor who comes, let's say, a 30% tax slab. For such an investor, these products become more like 5% post-tax, and hence there is a greater evaluation on what all opportunities do we have if we can make more than 5% on a post-tax basis. I think that basically summarizes our call today. I will cover the long short funds, but it will be unfair for me to not give you a bigger perspective. So on the debt side, we have category 2 and category 3 AIFs. AIFs are basically an alternative investment fund category. Category 2 pertains to investments primarily done in unlisted space. So if, let's say, we are running a category 2 fund, majority of our investments, which is more than 50%, has to be in unlisted space, and the balance can be in listed space as well. Which means that if you are doing, let's say, a private equity investment, it will be routed through a category 2 fund. Similarly, if you want to run, let's say, credit risk fund, where the yields might be 13-14% and sometimes even more, especially in case of distressed assets or real estate funds, you will have to come to category 2. The advantage of category 2 funds, I see clearly, is that these funds have a lock-in structure, let's say, of 4 to 5 years. And for these credit, risk-oriented papers, you need to give them time. Sometimes if you're running an open-ended structure and the fund receives a lot of redemptions, the fund manager will be forced to sell the paper in the market at distressed prices, which ultimately impact the returns at the broad fund level. So for these high risk papers or papers where the credit risk associated is high, the liquidity is very, very thin. And more often than not, you are kind of directly lending to the company. The company basically issues a debenture directly to you. Some of them will be listed, some of them will not be listed. So these kind of papers or products will by and large have liquidity issues, and hence these funds generally will come up in lock-in structures, 4 years, 5 years, or even more. Uh, but there is a better chance of these credit papers to perform in such closed-ended structures rather than open-ended structures. So from that perspective, investors who are comfortable taking that credit risk can look at category 2 funds. Having said that, one thing that investors need to be mindful is that while these papers, or these funds may have higher yield projections, basis the yield guided by the companies or the papers, but there will always be a very high credit risk on them. So if, let's say, your indicative yield on such a fund is, let's say, 17%, you should assume that some of these papers or, let's say, loans might get extended. Some of them may not get repaid at all. So in all safety, you should at least build in 300 basis points slippage on the yield part, just just to evaluate them correctly. And these funds, earlier had a mix of direct lending, which is through unlisted papers, as well as through MLDs. So to a certain extent, even category 2 funds have been somewhat adversely impacted because the MLD taxation now becomes full, which means that your overall taxation in these funds will probably go up from, let's say, 25-27% to now full taxation, which will be around 39 odd percent in a trust structure. So from these funds, what you can expect probably is somewhere around 8% post-tax CAGR returns. The numbers will vary very significantly depending on how the credit risk plays out. But on the average, this is what investors could expect if they are willing to ride for 4 or 5 years kind of structures. Assuming that economy does not go into a bad shape and your credit risks remain normalized, and if, let's say, the economy itself weakens, then you could have higher than anticipated credit risk playing out, which means that your returns will be lower. But for the investors who do not want to take, let's say, such high credit risk, and they want full liquidity option as well, they should look at category 3 AIFs. Now, in category 3 AIFs, there are debt plus strategies that we run. We also have a couple of strategies in category 3 AIF only. Now, by and large, this category has done far better returns versus your typical conventional assets by at least 300 to 400 basis points on a long-term basis. So let's say if you park money in a bank FD, or let's say in a debenture or a debt mutual fund, you can probably expect somewhere around 7.5% or 7% kind of returns at this point, depending on what the yields are and what the expenses are. So 7% pre-tax, it's decent, good returns. But this category generally offers about, or the historical trend has been that this category of long short funds have been able to make 10% kind of returns on an annual basis. And there is no credit risk associated with these long short strategies. Most of these funds will invest their entire AUM into either government bond papers or in liquid mutual funds, which entail zero credit risk. And they will overlay this fixed income offering with a long short strategy. All the funds in India, as I have seen, they deploy very, very low risk strategies on the derivative side. These derivatives pertain to our equities, which are traded on the exchange. Uh, Typically, some of these funds will do option strategies and equity long short strategies. I don't want to go into too much into details about the strategy part right now, but what I can tell you from the historical precedent and records is that these funds, long short funds, or the debt plus category, is able to make about 10% kind of returns on the average. Some years the funds might make less, some years the funds might make more, and this returns will vary across funds. So the best performing long short fund could have even made about 12-13% on a pre-tax basis. The worst might have made around 7% kind of return on a pre-tax basis. But if you were to compare these funds to, let's say, conventional assets, there is definitely a merit, there is definitely an alpha, and they come with almost zero credit risk or negligible credit risk and a monthly liquidity basis, which means that if you ever want to redeem your money, you can always ask for that. These funds will be able to provide you monthly exits. So it makes very, very compelling a proposition. Another thing that investors probably can keep in mind is that category 3 AIFs are the only investment platform where the taxes are deducted at the fund level. So the tax, basically the income that investors receive becomes post-tax, and hence they ought not to pay taxes again on that, which actually is a benefit in my personal view. What typically happens, let's say if you were to invest in a bond or a bank FD, is that while planning for your tax or advanced taxes, most investors I've seen, they miss on this other sources of income part. So let's say I've invested in bank FD, or let's say in category 2 AIFs, or even in, let's say, mutual funds now, and you are planning to redeem at some point, but you haven't really paid advance tax on that. So when the actual income gets added up in your income tax statement, you will have to pay tax on that, plus interest and penalty for not paying the advance tax earlier during the financial year. So category 3 AIFs actually solve that problem also, because category 3 AIFs themselves have to pay the taxes on behalf of the investors. So they make sure that they are paying the advance taxes at time. So you kind of don't have to take the headache for planning of the taxes or advance taxes that you have to pay. So category 3 AIFs pay taxes in their own pan on behalf of all the investors. And the taxes again vary from fund to fund. Some of these funds have been able to manage the tax part also well. So some debt plus fund strategies can come at 25% tax rate. Some of them will come at 39% kind of tax rate. As investors, we'll have to evaluate those tax rates also and post-tax returns at the individual fund level. But the good news is that these funds are generally making a strong alpha. I would say that broad category returns for a high-performing fund should be somewhere between 7 to 8% on a post-tax basis, which if you think, versus conventional assets like bank FDs or debentures or bond mutual funds, there is a clear 2 to 3% post-tax alpha. So I think now the investors are looking very closely to these funds and monitoring their performances, evaluating their risk, evaluating their tax management, and somewhere there lies a good sweet spot between risk, returns, and tax management, and that should really meet most of the investors' requirement as far as your fixed income alternatives are concerned. Kamal, I hope I answered your questions.
Absolutely, absolutely, sure, Harsh. So, because of this, obviously long short funds as a category now looks to be very attractive. And hence, the most important question, that if I have a long term horizon of say 5 years, and I kind of, aspire to create wealth, then over long only portfolios, which is kind of where there are a variety of fund managers, why should I actually look at the space of alternates? Because I don't see a long bias long short fund like yours, equity plus fund, delivering returns higher than Nifty. Obviously, and
Sure.
in long term for 5 year kind of horizon, the aspiration of a investor would be to generate alpha. Otherwise, he would kind of want to invest in an index fund, because if one has to generate returns equivalent to Nifty, right? Then why not index fund? Why long short fund?
Yeah. So, Kamal, your questions basically have two parts. One is, why debt versus equities, and within equities, should we go for index funds or look at active managers? So, frankly, while it is very tempting to think that we can allocate 100% to equities, and equities, historically has made far better returns than fixed income. I think if you look at last 10, 12 years of Indian markets history, which is I think more relevant a time frame, because generally your returns will fade as we are noticing. So last 12, 13 years average returns across market capitalization across various rolling time frames for Indian markets has been about 12 and a half. So clearly equities have done far better than debt, and there is no competition really between the two. If somebody is willing to take little bit of volatility and risk, they will always be better off with equities than fixed income, and that has been the historical trend. So it's safe to assume that this trend will be maintained in future as well as of now. And on a post-tax basis, equities are far more low tax products, far more tax friendly than debt. So it will make far more sense for investors who can commit long-term capital. They should commit a substantial part of their capital to equities. But having said that, globally, what we are seeing is that that does not really address the financial problem that the investors are trying to solve. I will give an example. When I talk to, let's say, businessmen, and when I talk to, let's say, salaried class people, the CEOs and all who are part of my fund, most of the businessmen want exposure to fixed income. Their view is that their business itself has a whole lot of volatility, and whatever they are earning in terms of surplus, which is not going back in their investments, part of it goes into equities, but a larger part they want to be allocated on the fixed income side, because at the end of the day, they want some assurance that they get some fixed income returns. Should there be any problem in their business or in, let's say, in equity markets, and generally these things tend to come together. So if the economy goes down, your business generally will be affected adversely, and your equity returns will also get affected simultaneously. So it makes a whole lot of sense from their perspective to have a decent allocation to fixed income, which assures you on the capital preservation side, as well as generates a source of income for you. and it comes in very, very handy in bad times. Whereas if you look at the salaried class who, let's say, get high salaries on a monthly basis, so they have a very strong, steady, fixed cash flows coming in. These kind of investors are willing to risk, take additional risk. So they like private equity kind of funds. They like taking exposure to hard equities, and they are not so attracted towards, low risk products like debt funds. But if you look at it and think about it, 90% of the investors are not, either risk taking or risk averse. Most of them are just trying to manage their cash flows. The ones who have greater, variance in their cash flows or sources of income, they want more assured returns. The ones who have more assured sources of income, they want higher risk. So at the end of the day, all of them, by and large, most of them are trying to, balance out the cash flows. So I will not mix debt with equities. I would say that there is place for both. And the data, hard data, is that still larger allocation goes to fixed income versus equities at a global level, not just at a country level. So that will not change. That will remain. So now the question or the pitch that we have, as a category developer, is that if you're looking at category three, does it have a strong merit when you're designing a debt kind of a strategy, fixed income kind of strategy? Does it have a strong merit over the conventional assets, let's say your bank FDs or corporate deposits or debentures or the debt mutual funds? Does it have a strong alpha over that? The answer is a very clear yes. I mean, you have aggregated the data at an industry level for multiple years, and I think if you were to pull out the, let's say, alpha returns of these funds over conventional assets over the last 3 years, that alpha might be as high as 5 to 6%. I'm assuming that the industry does not make as high as alpha as 5 6% as what it has made in historically. But let's say even if that alpha compresses, it is still very, very strong alpha, especially now that the taxation across the board is similar or comparable. Now the question comes to equities. When you run a long only AIF, does it have a merit over, let's say, your conventional assets like equity mutual funds? So firstly, AIF category 3 or category 2 is a pooled account. So it's pooled assets. And in that sense, the way we operate, or manage a fund is very, very similar to a mutual fund structure. So some of these long only AIFs, as you would have noted, would have done very, very well. Generally, the color of long only AIFs will be mid cap, and some funds which are multi-cap oriented, and some very few which are large cap oriented. The performances, I think, will be strong in both the cases, depending on the investment team that you have. So I think the performance of long only AIFs will be strong in both the cases. I'm sorry about that. There was a technical glitch. So what I was mentioning was that equities and debt have to be kept separately. And as far as equities is concerned, it does not matter too much whether you're investing in long only AIFs or mutual funds. What matters more is the investment team that runs the strategy. And if you find high performing funds, high performing investment teams, you will almost always be in good hands. Your long term compounding will be very, very strong. So from that aspect as well, investors should really closely evaluate all the equity products too. But long short funds, they should not be compared to equity funds. long short funds basically cuts out the whole market direction risk, and they try to make debt plus outcomes. And globally, that has been the precedent, for the hedge funds. There are some high risk taking long short funds, but I don't want to discuss about that strategy. That strategy lies somewhere between debt and equities. So it again has to be seen as a hybrid structure. And then when again you are evaluating a hybrid structure, those products are already there in mutual funds. So the easiest way to evaluate, such equity-linked long-short products is to compare them against the mutual fund performance. If they are doing better than the mutual funds on a sustained basis, then they require a very close merit. But pure in simple terms, most of the long-short funds will be geared towards, fixed income orientation rather than equities orientation.
Sure, Harsh. I think you have kind of summed it quite well. So, right, category three long short funds need to be compared for alpha with maybe their debt counterparts because obviously they are maintaining lower beta, and not to be compared with equity funds. So that is quite well answered. Now we want to understand, because we are living in an era where investors want to deep dive the overall portfolio in terms of construct strategy, and because category 3 AIFs are closed in this context, they do not share the underlying fact sheet on say monthly basis. They share that on quarterly basis, and then also it is difficult to understand because it is a long short space, and because there are too many funds with variety of, I would say, strategies. So I want you to explain in a simple manner that what are the maybe two or three or four styles which are available in this entire industry. Let's first talk about this ecosystem, and then we'll come to what is your style. And then obviously while you explain the entire style and approach of long short fund management across various approaches that various fund managers and fund houses have, you may also want to take some examples of some of the stocks so that it is easy for the audience to understand and kind of visualize that how these portfolios are being managed.
Sure, Kamal. So firstly, on the disclosure part, yeah, most of the funds give very minimal disclosures. There is a compulsory disclosure on a quarterly basis. So if you ask for the quarterly report for any fund, then the investors will be able to see the entire positions on the portfolio, the fixed income as well as equities and equity derivatives. But on a monthly basis, there is generally less disclosure. The main reason here is that these positions that the long short funds take, they are of low duration. From an investor's perspective, they may not have to really look into the positions because they are always changing. So long short fund managers generally are very very nimble, and they ought to be. Now, with respect to the strategies that various funds adopt, I will give you some of the main ones. The first and foremost strategy is equity long short. So here, the whole idea is that you buy a diversified portfolio of stocks, which you believe as a fund management team that will outperform the index. So wherever you are seeing absolute upside, wherever you are seeing there is a good potential for the stocks to outperform either in the short term or in the long term, you buy those. Now, when you do that, you're exposed to the market risk, which you don't want to take because at the end of the day, you're trying to reduce the volatility and trying to make a debt plus sort of an outcome. So what you do is you simultaneously develop a short portfolio of stocks in equal quantum. For example, in our long portfolio, let's say we take 1% exposure each in 25 stocks. Then on the short portfolio also, we roughly have to be around 25% on the short side. Say we take 20-25 stocks there and create 1% position at this individual stock level. Now, you could theoretically run a concentrated position also, but it is not advisable to run concentrated positions because some of these bets on both longs and shorts will go wrong every single month. And if a concentrated bet goes wrong, then it will show up in the returns. It will show up as a drag in the returns, which you want to avoid. So internationally, the best practice is to keep low positions across the board, have 50-60 stocks at least in the portfolio, and have a balanced portfolio where your both longs and shorts are equal. So let's say if market rises, both longs and shorts rise. If market falls, both longs and shorts will fall. The only way this strategy will make money is that over a period of time and gradually the long portfolio will start outperforming the shorts, and you will get some returns out of that without having to take market direction risk. Having said that, while it's very easy a concept, it's very strong in terms of risk management. You will hardly get a large drag in returns if you adopt this strategy, but it will require a very strong investment team, some very sharp stock picking skills, because primarily you will be dealing with the top 200 names, which are the most liquid names. So whether you are adopting a fundamental style or you're adopting a quantitative style, stock picking skills and experience will basically determine what your outcome will be. So this is about the equity long short, which is one of the strategies. The second strategy is that you take directional bets. So theoretically, if let's say you have developed a quant model or let's say a macro trend model, which indicates that the market is bullish in the near term, so you don't look at these stocks too much, but you simply take large positions in index. So if market looks bullish, you take large long positions in index. If the market looks bearish, you can take heavy short positions in the index itself. So you can ride the market up and down. Again, it depends on the skill set of the investment team. If they have very strong quant models or macro models, which give you a decent prediction about near-term trends of the market, you can adopt this strategy. So many funds will adopt this as well. The third is volatility trading, which is a very popular strategy for these hedge funds, but more so in India. Why it is more popular in India is simply because it is very profitable in India. It is not so profitable, in global markets. Although many funds are trying to do globally, but what we have noticed is that at least in the last 2 to 3 years, for volatility trading, India has been the best, really the best market. Here, basically, you write, the calls and puts on the index, and if let's say index moves within a range, then your both calls and puts value compresses, and you make money on them. But index will keep moving up and down, so you'll have to keep monitoring that, and depending on your risks, you will have to cover up the positions. This has been a very simple strategy to run. It's been very profitable, especially after the introduction of the weekly options. And it is very popular. Many of these long short funds adopt this strategy as well. The fourth strategy that I have seen that some of these funds in India are adopting is on the commodities side. There are opportunities on the commodities derivatives trading. So funds which have expertise on the commodities, they use that market as well. See, for the long short funds, the good thing is that you can trade anything. You can even trade currencies, interest rates, commodities, indices, and even stocks. It really depends on what skill set the investment team has, what's their track comfortable with. Now the question is which kind of strategy should investors really look at? So I would say that for foreign fund, it's always best to have a mix of strategies. While a particular fund A may have expertise in, let's say, strategy X strategy, a fund B may have expertise in Y strategy, and so on. But what I've seen is that even strategies have their own cycle. So long short strategy, it goes through a very strong phase when the market alpha is very strong. Then sometimes that alpha weakens, so then it goes through a lull phase. Similarly, index options trading, which is again a very popular strategy, it has gone through a very strong phase in the last 2.5 years, and now we are noticing that there is a decay in the alpha on that side. So all these strategies that you can think of, they will have their own cyclicality, and obviously there is a fund management team expertise in certain strategy. So the best fund, in my view, is one that has a mix of all the strategies, where where the investment team has the skill set or the experience in running and managing all these strategies. So, it will be easier if, let's say, one strategy is hot, it's making money. You can theoretically allocate more money or more allocations to those strategies that are making money, and less to the ones that are not making money. So if you are able to design fund where there are multiple strategies and the skill set of the team is also very diversified, generally your outcomes will be strong across market cycles and market phases. So investors will need to take a very hard look on such long short funds, on their capabilities, and then choose accordingly. I don't really think that investors should really worry too much about the disclosures. Even if there is full disclosure, investors will not be able to make any sense of that. Only thing that you need to look at is what has been the historical performance. If the fund has gone down, then how much it has gone down by. What might surprise you that these long short funds are actually exhibiting even lower volatility than fixed income funds. In fact, most of them have far fewer down months than the debt mutual funds. So, which means that they are certainly safe option. You don't have to worry about it too much. Uh, Please look at the historical track record. Please speak to the investment team. Look at their skill set, and try to get a sense of what kind of post-tax returns outcome the funds will be able to generate for you. I think most of the investors will be positively surprised now, given that the taxation is similar across debt offerings. I think there is a very clear 2 to 3% post-tax alpha on the long short side.
Sure, Harsh. So we move on to the more specific aspect about our discussion now, in terms of discussing Tata's long short fund offerings. So obviously you have covered the space quite nicely in terms of educating me and everyone, our clients who are logged in for this webinar, on what is the need and what is the benefit of considering an alternate investment fund, by which is kind of a long short fund. But yes, your both funds in the respective category are doing good and they are giving decent returns. So as your AUM is growing, you will continue to kind of face this question, that will you be continuing this performance. So what is it that is being kind of done for this particular aspect? Obviously we want you to explain to us both your offerings, but more important question is that yes, today your products have become popular, and we have seen as a product becomes popular, it gets more and more inflows, the performance actually goes down. Maybe fund managers become complacent, or strategy becomes difficult. I'm sure this applies to long short all the more. So what is your answer to these questions?
Yeah, Kamal, I see some questions on the chat box, so maybe I'll just quickly touch base on them, then come to our specific ones and the questions that you have asked. One question is that if somebody has a long-term horizon, then should one opt for balanced advantage fund or a long-short fund strategy? So long-short strategy, as I explained, is more debt plus. There are a few funds which can be compared to balanced fund also. So let's say if you have a long-short strategy, which is, let's say, 60% long and maybe 20% short. So which means 60 minus 20 is 40%, which is your sensitivity with the market, which is where balanced advantage funds are positioned. You can definitely look at those strategies. I think there is only one fund in the country which is consistently doing better than the balanced advantage funds. I don't want to brag about it, but it happens to be our fund. But I cannot say the same about the category overall. But there are other long short funds also which have done quite well with equity orientation. Uh, so, so this is a question from Bhargav Patel, and I think you will have to evaluate. You have to compare both long short, equity oriented long short, and the balanced advantage fund. You will find some couple of interesting funds over there. Uh, there is a question on the PMS long only. Yes, it's always a good time to invest in equities. You will have to evaluate each strategy, independently, which one is making sense. There is a question on whether NRIs can invest in long short funds. Yes, NRIs can invest in long short funds. Most of the funds will be happy to take money. There is some restriction, let's say at our fund level, where we don't take money from US based or Canada based NRIs, but otherwise we can take money from anyone. Can I show some light on the derivatives margins? Yeah, I mean, so in long short funds, if you're, let's say, if you have to design a derivatives portfolio of, let's say, 100 rupees, then you have to give some collateral. You don't have to necessarily give cash. So if you give collateral, which could be either in form of liquid mutual funds or government of India bonds or even stocks, for 100 rupees kind of derivatives exposure, you just need 300 rupees or 400 rupees of collateral. That is more than sufficient. So because long short funds will get whatever capital they get, they just have to place some part of it as collateral. I think that is more than sufficient for any derivative strategy that you want to run. So there is no issue on this collateral. There is no cost to it. In fact, even at your individual level, you can use the same principle. Can I throw some light on returns being calculated? Yeah. There is a monthly NAV process for most of these funds, and this NAV becomes applicable for all the inflows as well as redemptions. But it's not a hard rule. For example, in our funds, we allow the inflows twice a month. But for processing the redemptions, we declare the month and NAV. So if somebody needs money, in between the month, then they will have to wait out for the month end, and then we are able to process the redemptions. In they finish now. For debt AIFs in category 3, the taxation is at the fund level, and the taxation will vary. Please do not be mistaken that long short strategies or debt plus kind of strategies will attract full taxation. Our funds do not attract full taxation. We manage that tax quite well. You will be surprised by the taxation that we have our funds have attracted. We try to manage the taxes as well as we can. So there is no defined tax rate for category 3 AIFs. It depends on the contribution of income stream. So you will have long term capital gains, you will have some derivatives income, you will have some other sources of income, and each income stream will attract a different applicable tax rate. So depending on the contribution of each income stream, the taxes will be determined at the fund level. So please do not be mistaken that these long short funds are full tax products. Some of them are, but not all of them for sure. Now I'll come to your specific questions about Kamal, about if let's say first concern is whether the performance comes down when the long short funds size increases. So I would say that in my mind, if let's say there are strategies which cannot absorb too much capital. For example, if you're trading too much of stock options, so stock options are by and large somewhat illiquid. So if your capital is increasing and you're allocating more capital to stock options, then there will generally be an impact cost, so which will hurt your returns. If you are doing, let's say, index options trading or index trading or equity long short trading, then the size or increase in size really does not matter. Indian markets are highly liquid. In fact, derivative segment is far more liquid than the cash market segment. Many of you may not know, but stock futures have almost 4 or 5 times liquidity versus the stock itself. In fact, many of the mutual funds are now using stock futures when they have to take swift trades. So size is not a concern if for equity long short strategy, for index trading strategy, for volatility trading strategy. But yes, size is too big a size is a problem for stock options trading. So to that extent, you cannot scale up that strategy. Having said that, we have noted performance has decayed for performance has been choppy for many funds, both long only and long short. I think it's not a function of size as much. It's a misunderstood concept. The Like I mentioned sometime earlier, that there is a alpha cycle for the strategies themselves. So if the problem that many of these funds have had is that they've relied too much on one single strategy, and if that strategy goes through a good phase, you will make good money irrespective of your AUM. and if it goes through a lull phase, you will not make very handsome returns. Which is why I emphasized on the point that it is important for not just for long short funds, but even for long only funds to be more nimble, to have multiple kind of thought processes and approaches to investments, and for long short funds to have multiple strategies going in the fund. And if they have multiple strategies, then their outcomes will be generally healthy and strong. And in our funds, we are trying to do the same. I will come to my funds now. We have a multi-strategy approach in our fund. From investors' experience perspective, I think there are three most important components. One is the returns, second is your risk, and third is your taxation. Ultimately, the investors experience post-tax returns, and because the taxes are deducted at the fund level, we ought to manage that as well. So from returns and risk perspective, just give me 2 minutes to explain this. Uh, if you have more strategies coming in, your returns outcome will improve. Something or the other will keep working every month. What will also happen simultaneously in a multi-strategy fund is that your variance in returns will reduce. Uh, it's possible that one strategy is not working, then the other strategy is working, and it is able to offset the drag from the first strategy. And there will be months when, let's say, both of them are doing well. So from returns perspective, your returns get enhanced. But the good thing is, at the same time, your risk is reducing. We have done far many studies on this concept, and we have also applied asset combinations. So it might sound very counterintuitive, but I can tell you that it is true that for these long short funds who invest fully into debt and overlay it with a long short strategy, the combined risk of long short and the debt portfolio is actually lower. It's actually lower than the risk of the debt portfolio alone. So as to the extent you can combine various asset classes and various strategies, your returns will improve, and at the same time your risk will reduce. And that is what matters for the investors when it comes to get safe and consistent kind of returns. From the tax management perspective, it is individual's thought process. There is no there aren't any defined ways how to manage these taxes. At our fund level, we try to do our best, and we ensure that the tax attracted by the funds are minimal. So we try to focus on these aspects as principle. Then from strategy perspective, one hard principle in our funds is diversification. If we are doing equity long short, then we ensure that we have at least 50 60 stocks in the portfolio, sometimes even more. And our single stock exposures usually should be contained within 1%, which allows us to make returns. But at the same time, when we are going wrong, we don't go wrong too much. So a bad month for us, could be like 50 bips down, and a good month for us could be like 3% up. That's a broad range we try to manage our funds within. Uh, and if you are allocating money to, let's say, volatility trading or to index trading, then again we have allocation processes. We don't want to over allocate to any strategy. So 10 to 15% is where we are comfortable with these add-on strategies, and that allows us to make more consistent returns. In terms of positioning, we have two funds, very broad approach that we follow. One is a debt plus product, which will have no sensitivity to the market. Markets may go up or down. It does not really matter for that fund. It is maintained very neutralish. So we have some portion which is long, some portion which is short, and both are somewhat equal in quantity, which means my sensitivity to the market reduces. What this strategy basically relies is on alpha. My long portfolio outperforms the short portfolio, which is where we get the extra returns from. So there is one debt plus strategy that we run, and then there is one equity saving strategy that we run. In the second strategy, it's a very low risk strategy again, but here our long portfolio is bigger than the short portfolio. So let's say it's a 60-40 fund, 60% long and 40% short, with just a 20% sensitivity with the market. So over a long period of time, we know that equity markets are going to go up. So a net long fund, like the second one, will generally do well, structurally over a long period of time, because it will benefit from markets rise. Having said that, there will be phases when markets are weak, then its performance will be somewhat soft, but it will still hold the ground. So that fund is positioned, on both, for primarily again for fixed income investors who want some equity participation, but they don't want to participate on markets downside. So the second fund protects the investors' money when the market is going down, and it often comes out positive. And if the markets are rising, then obviously it does better, far better than the debt funds. Again, it's a debt-oriented strategy, which suits conservative investors. But theoretically, we have the second fund, we can design a third fund, and already there are many funds in the country. If you increase the equity linkage, your participation with equities will increase. You can make a more equity linked aggressive hybrid structure as well. Where we are seeing greater interest from the investors is on the conservative side, and hence our products, our two popular products, are on those side. When we see investors interest increasing towards equities on in this space, then we launch the third fund as well. But the concept is same, a diversification, and most importantly, the long portfolio has to outperform Nifty, and we are very very mindful of that. And our skill set in picking the right stocks on both longs as well as shorts helps us to make consistent kind of returns. So these are two small funds.
Sure, thanks, Harsh. So for the benefit of audience, I would just like to add few more points, from the point of view of maybe specialist of some of these products in terms of articulating for the audience. What happens, equity markets, whenever it goes down or goes up substantially, it happens in quick couple of months. It doesn't happen throughout the year. If we see history of equity markets, even last 40 years, or see last 2 3 years, we have seen equity markets going down in few bad months and going up also in few very good months. Even now, over next 2 years, investors ask us what is going to happen, what is expected, though nobody knows that. But one can know from history that if equity markets are to actually good returns in say next 2 years, then it will be maybe concentrated across few months. And similarly, it happened in the past also. So given this as a premise, what happens in long short funds, those extreme good months or extreme bad months are taken care very well, whereby in extreme bad months, the because beta is kind of one fourth of the index, which is like 0.25, these funds will protect the downside. If at all timing of any investor in investing into equity product is wrong, and after he invests, that bad month hits, he will be down by only say one fourth of the market. And otherwise, in other remaining months, market actually remains range bound. In those range bound months, these long short funds try to generate positive returns. And hence overall, we have seen in last 36 months, if you were to see the performance of Tata's equity plus long short fund, there have been many bad months in between when Nifty would have fallen by say negative, when Nifty would have given negative returns 14 times in last, I would say, 36 months. So almost one third of the month it has given almost negative returns. But long short fund of Tata would have given negative returns only in 5 out of these 36 months, and in long term it has delivered returns equivalent to Nifty. So this is because of the consistent positive return coming over those range bound months and protecting extreme downside during those extreme bad months. And that is where the experience of investors in long short funds is good. At the same time, they make returns equivalent to index funds. So obviously, if you put money into I would say blind index funds, you will tend to lose your patience. Your experience could be bad because there could be a bad month after you have invested. But here, your downside would be protected. So that is what makes these long short funds attractive. But obviously, there are a lot of intricacies involved, and taxation is something which kind of investors ask us is what makes these funds, I would say, unfavorable. So I would want Harsh to cover that aspect also, because you claimed that across both your funds you're managing taxation quite well. So what is it that you are doing differently than others? Kindly explain how does taxation work first in this category, and then obviously how is it that you're managing it, I would say, accurately.
Yeah, so I will take the first part of your question for, I mean, first. So, firstly, on a post-tax basis, I don't expect my funds to beat equities. Let me make it very, very clear for the investors. Currently, we are doing almost as much as Nifty, on a gross returns basis, but on a post-tax basis, we will never be close. Because our funds are not equity oriented, we are, more debt-like. Let me give you a number for a second fund. The average return for the fund only for the bearish months. So Kamal mentioned about 15 months that Nifty has been negative. If you remove all the other months and just talk about how did the fund do in these 15 months, both our funds, so we generated a positive return on the average in these 15 months alone. The debt plus strategy made 1% plus on this monthly basis. The second fund, which is linked to equities, even in this bearish months, it made about, I think, 60 bips positive return on the average. While I don't want to talk about my funds, but it's really unfair for me to compare our funds to equities, and I don't expect to beat equities in post-tax basis on long term. That will not happen. Our products are positioned on the fixed income side. Let me reiterate very clearly. We are trying to give investors a good fixed income experience, which they will not get on the conventional asset side. When the time comes, we will design an aggressive equities product, and then I will talk about how my funds did versus Nifty or index or multi-cap fund. But currently, my offerings currently are only on the fixed income side right now. The second aspect is, at the industry level, will long short funds beat, index? I personally don't think they will. Equities investors should really not come into long short investments. Long short should be seen as either fixed income or hybrids, and most of the long short funds are actually conservative hybrids. They're not even aggressive ones. There are, I think, only 3 funds which I have seen which are on the aggressive equity side. If you want pure equities exposure, Kamal is the expert. He has full evaluation on the PMSs and long only AIFs. Please look into those products. Don't even consider long short funds for your equities allocation. The second question is with respect to taxation, that I can maybe talk about a little bit. So let's say in our funds, there will be income streams. So let's say if we park money in liquid mutual funds, some income will come from that. If we park money in, let's say, tax-free bonds, we will get some returns from that. If we park investments in Government of India bonds, we'll get some returns from that. If we park money in stocks, then we will get some returns of that. Now, the thing is that the tax rate for each income stream is different. For tax-free bonds, the tax rate is 0. For Government of India bonds, the tax rate will be full. For cash stocks, and your cash stocks do well and far better than Nifty, which is what I said in the beginning, that your long portfolio has to outperform Nifty substantially. So if it does outperform Nifty substantially, large part of your returns will become capital gains, because stocks will attract LTCG or STCG depending on your holding period. So there will be different income streams coming in your fund, and there will be a different tax rate applicable on each of these income streams, and that will determine the tax rate for the fund. Now, the question then is, why is it that not all funds are adopting this? You can combine these asset classes like we do in our funds when you have a very good sense of how the combination of these assets will work out. At the end of the day, I am responsible for a combined outcome to the investors. I cannot say to the investors that markets have been bad, hence our stocks also fell down, hence we posted a negative return. No, I don't have that luxury. So I have to combine different assets in a way that the combined outcome of all these assets and strategies is very, very range boundish. It should at no point suffer a massive drawdown. So that experience or that skill set, comes with some experience, and I have developed that experience. My team has skill set in these products, and which is why we are able to come up with a blended tax on our funds. And that blended taxation, like I said, will be lower than your highest tax rate, depending on which income stream contributed how much to your overall returns. So I will not talk about in detail about those funds and the income streams that were applicable in our funds. But what I can tell you for sure is that with this approach, you can reduce the taxes. Having said that, it will be slightly tricky to combine these assets in different combinations at different points in time. And that is the hard part, because at the end of the day, you're still responsible for making positive absolute returns for the investors, no matter what the market conditions are. So you will require a different kind of a skill set, which is what we bring in for the investors.
Sure, Harsh. So generally, whenever I have spoken to long short fund managers, this is the last question, of this webinar. Long short fund managers always try to create, I would say, pessimistic view about markets, be it around macros or be it around valuations, because it seems that the pessimistic times is what long short fund managers look for, because that maybe gives them better, more conducive environment to give higher returns, or fear in investors kind of makes them go away from long only products and kind of go to long short products. So what is your thought process in this regards on equity markets in Indian context after 2 years of disappointment at this point of time? If an investor is confused and is in that state of mind that should I invest in long only or long short, he has a clear 3 5 year horizon. You have partly kind of given answer in favor of long only equities, but now I want you to answer this particular question in this regards.
Yeah, see, there are always, frankly, risks on macro side. More often than not, there are global risks. I think our domestic risks are low. The only risk that we face domestically is the demand slowdown risk or consumers becoming weak. But otherwise, in terms of overall leverage in the system, the corporate debt, the government, debt and all that, we are pretty strong. So all these risks that relate that we talk about are primarily macro and primarily emanate from US. And again, the translation for Indian markets is a growth slowdown. Nothing contagion. Having said that, what we need to be also be mindful of, and this is my honest observation, is that India is an expensive market, which does not mean that the markets will fall. If your starting point on any asset class is high, your purchase price is high, your future returns will be somewhat soft. That is the only thing. And I believe that Indian markets will forever remain the most expensive markets or one of the most expensive market. We really cannot fight that. Our purchase price for these stocks will never really sustainably come down. So it really, investors should really not worry too much about market corrections. If they do get and they have cash, surplus cash, they should deploy those. But having said that, you will still need to, think about, what returns equities are going to make. I gave a data point that last 12 years it's been 12.5% across market capitalization, across various time frames. I do believe personally that the future returns will be softer than your historical returns across asset classes. Whether you take cryptos, whether you take real estate, whether you take bonds, whether you take anything, your future returns will be somewhat softer, and that will always be a structural trend. So in that context, you will have to, if somebody is thinking of 15%, returns from equities over next 5 years, I would say that please wait out, let the correction come in, and then your purchase point will be strong. Or I can say that please readjust your expectations. 15%, 5 years is very unlikely in my view, personal view. So while somebody could present a pessimistic picture or optimistic picture. Hi, sorry about that glitch. So I was referring to the point about the overall outlook for equities. So in my view, if you have surplus cash, if you are willing to take that risk, please allocate money to equities. Long short managers, they have a tendency to look at the global macros, and more often than not, the global macros have something which which is against the rosy pictures. So which is why they might talk somewhat pessimistic. But I mean, you should always evaluate from long only perspective at what the economic outlook and the market outlook is. Having said that, while market could do what it does, in every phase, in every bull phase, bear phase, or consolidation phase, the best part about the markets, and nobody can deny this, is that some stocks will flourish. They will do extremely well, and there will be a whole lot of companies that will not do well. Even in the strongest of the bull market phases, there will be stocks at different points which will go down and which will make money for the short guys. So I personally don't worry too much about what the market returns will be. Frankly, I'm happy to allocate my long only money to the fund managers who have good insight on the companies, who are good stock pickers. So I don't then have to worry about market cycles and what returns markets will give. I'm assured that there will be some alpha over and above that. So I think the evaluation should be far more on the stock picking skills and the alpha that the funds generate, whether they are debt or equities. And if you have invested with good fund managers, you should be rest assured that your compounding will be very strong irrespective of market cycles. So please look at the fund management skills, the individual fund performances, rather than what market cycles we may be in. Let managers do the allocation between debt and equities or cash. Let them choose the stocks that will do well over the next 1 year or 2 years. I will try to repeat that in all market phases, there will be some stocks which will be in bullish phase. There will be some stocks which will be in bearish phase. Some stocks will always run up sharply, and some stocks will always fall. So it will really be up to a good fund management investment team to pick up these good ones.
Sure, Harsh. I think you have summed it up quite nicely and in favor of maybe long short funds only because, as you mentioned, that some stocks will be in bullish phase, some stocks will be in bearish phase, and that kind of makes the ground quite, I would say, conducive for a long short fund manager. And such opportunities always remain. I will sum it up for the audience. For those long term investors, like somebody was asking, should I invest my retirement corpus into a long short fund? See, the idea really depends on your horizon. For a pot of money where you want to invest money for long term, which is like more than 3 years, you should be ideally investing into a long only product because long only product will give you alpha. And because you are wanting to sacrifice the returns or the liquidity part of your investment for next 3 years, you ought to focus on alpha. But obviously for that pot of money, which could be corporate money or which is a money meant for treasury requirements, where the horizon is less than 3 years, but there one cannot expect income generation, liquidity, as well as alpha. And there comes the space of some of these debt type, I would say, long short funds, where the comparison has to be with debt products. And here all these long short funds have generated substantial alpha if compared to FDs or compared to any other debt or fixed income instrument. So it is the investor's time horizon on a pot of money that he's wanting to invest, that he needs to focus upon. And then obviously there are variety of long short fund managers, variety of approaches, variety of styles. Investors should understand all these styles and should deep dive and should understand the fund managers conviction and consistency in returns. And that is where we think that Tata's funds have actually done consistently well. Obviously, we leave it to investors to kind of do that deep diving. We, being PMSAF World, one of the top-notch platforms in the space of alternatives, have created this entire mechanism of studying all these funds in the space of alternates across quality, risk, and consistency attributes. We do it quite nicely, and we welcome all the investors who want to deep dive this space to make their portfolio, to book their appointments with us. We'll be more than happy to educate, guide, and kind of handhold any of these investment decisions that investors want to make. With us, we can assure you that you will be making all very well informed investment decisions. We are not biased to any brands or any large AUM oriented, I would say, companies. Our approach is very analytical. And I would sum it up here and thank you everyone for joining us today. Thank you, Harsh, for your time.
Thank
It
you,
was
Kamal,
quite
and thank you,
insightful.
audience. Thank you.
Pleasure.